Uh, Dear, I welcome all the members present for this virtual webinar on behalf of Women and Young Members Excellence Committee of ICI. I welcome you all in the Youth Excellence Symposium Series 9th. Youth Excellence Symposium is a 5-day series of program conducted by the committee for the women and young members. It is one of the Women and Young Members Excellence Committee's initiative to not only disseminate information to the members on technical updation, but also to empower, inspire them to come at forefront and realize their verbal skills at public forum. Also to give them the opportunity as to various practice opportunities in the respective fields. Today we have our coordinators, CA Priten Shah, CA Jignesh Gala, and our very own speaker, CA Kartikeya Kandoi, who is a master on the subject that we are going to cover today. The topic for today is practical aspects of ESOP implementation and ESOP valuation. Without wasting much of the time, I'll request CA Jignesh Gala to please introduce the speaker for the today's session. Jignesh, you are on.
Hello. Hello. CA Karthik is our fellow chartered member. Is also fellow actuary for India, UK, and Sri Lanka. He is also Central Council member of the Institute of Actuaries of India. He is also topper in the subjects, special technical employee benefits and pensions and core application modeling documentation in the actuary exam. He has given more than 50 lectures on this subject. He is founder of the Kandoi CA and Mrs. Kandoyan's company and has 9 years of experience in this actuarial field with respect to employee benefits. His expertise lies in 360-degree actuarial accounting and advisory globally in employee benefits, including ESOP implementations, valuations, and as per Indian GAAP, INDAS, and IFRS UK GAAP, US GAAP, and is also readily available as and when requested. So, without wasting much time, we'll give the dais to the CA Karthikeya sir, and we'll thank him to give us valuable time here. Over to you, sir.
Thank you very much to the institute, the committee, and Gautam Bhai for this opportunity. So, let me share my screen. Just let me know once the screen is visible. Yes, okay. So today we are going to discuss on the practical aspects of the ESOP implementation and the ESOP valuation. So first question may come to all our mind that why ESOP is very important, why we are going to discuss the ESOP, then what are the opportunities available to our chartered accountant friends. So in the ESOP, if we talk about it's a retention tool which is given whereby company gives the equity shares to the employees of the company at a discounted price from the market value. So this is the main tool of the ESOP. So if I just let me first cover the today's agenda. First, we will see the overview of ESOP, the key terminologies like vesting period, exercise period, exercise price, etc., how they can be set. Then we'll come to the ESOP implementation process. What are the steps required for the listed company, unlisted company? Then we'll jump to the ESOP valuations. What is the formula for ESOP valuation? What are the key parameters into the valuation? How they can be selected? So how any valuer can do the ESOP valuation, that we will cover in that. Then once you have the valuation, then how to do the ESOP accounting, that also we will cover, and then group share based payments. So this is broadly our today's theme. With this, let us first discuss about the overview of ESOP and its key terminologies. So if you see that this third chart over here, ESOP. So mainly this is a plan where we give a kind of the ownership to the employees, because in ESOP we are making the employees the equity shareholder of company, so they will become like a partner in the company, owner in the company, because they will get the equity shares. So this is mainly to align their interest, to make them the feeling of the owner, to so they can enjoy the benefit. Whenever company share price increases, they should also get the benefit. But one thing we need to all keep in mind, that ESOP is only an option. It is not directly a equity which is given. We are giving only a option to the employee. So we need to understand the life cycle of the ESOP and the benefits of ESOP to the company. So first, let us see what are the benefits of ESOP to the company. The first important benefit is it will align the employee's goal with the company's goal. So what is the employee's goal? That they want to gain more benefit, and company's goal is the maximizing the shareholders' wealth. But when employee will also become the shareholder, they will be aligned to the company's goal of the maximizing the shareholders' wealth, because now they are also the shareholders. So this will align the employee's goal with the company's goal. Now we are required to, and company wants to reward the employees for the past contribution. Because of their past contribution of the employees in the company, today company is at certain level, so company want to contribute the employees for their past contribution, but at the same time they want employees to do much better in the future, in the longer term. So that's why this is a tool by which employees are compensated and provided the benefit for the long-term contributions. And this long-term contribution is for the past period as well as for the future period. Why we are saying the future period? Because in case of ESOP, one needs to render some future service as well. Then only they will receive the benefit. So that's why there has to be some future service, future contribution by the employee in the organization. This is a tool which will work to retain the employee, because as we said, employee need to render the service to stay in that organization, to work towards the growth of the company. So that will ensure that we are attracting and retaining the employees, because otherwise it may happen that employees may leave the organization, there can be more attrition rate. So this is a tool by which company is ensuring that attrition rate is coming down. When we do the attrition rate analysis for the companies, then we found that employees who have the ESOP, they have the lower probability of leaving the organization as compared to the other set of employees. Then this also gives a job satisfaction to employee, because they are getting more than the regular salary, because this benefit can be multifold based on the increase in the share prices. Then lastly, this is a kind of a long-term employee benefit, because this is given to ensure that employees stay for a longer period, and then for the longer service they get the more benefit. So that's why this is a kind of the objectives why company come up with the ESOP plan. So whenever you consult with the companies, you need to find what is the pain point in the company. Based on that, we can discuss with the companies that how ESOP can be aligned to their goals. Now, what are the different type of ESOPs? Because in the market practice, it has been seen that ESOP is sometimes loosely used as an interchangeable word for various different type of benefit schemes. In principle, there can be 4 different type of option schemes, or you can say the benefit schemes as a share-based payment. The first one is the employee stock option plan, ESOP. This is a plan where we are giving the option to the employee, which will vest to them as per the vesting criteria, and they will become the shareholders once they exercise the benefit. So it is like a call option we have given to the employees. And the final benefit will be in the form of the equity shares. So that's why it is called as a ESOP. The second type of benefit is a share appreciation right. It is a type of cash settled share-based payment. where company is not issuing the equity shares as a settlement, but giving a benefit which is linked to the share price. So, for example, today's share price of company is 1,000 rupees, and they give them a benefit that in future, let's say after 2 years vesting period, the option will vest to the employees, and whatever growth in the share price from the 1,000 rupees, that will be paid as a share appreciation right to the employee. So this is a type of the cash settle share based payment. So the organizations who have the more availability of cash, they can afford this kind of plan, because here the payout is in the form of cash, and here the payout is in the form of the equity. The third one is a plan which is a share based payment with the cash alternative. So company can give a plan which is a combination of both the plans, where again the selection choice can be available either with the employee or it can be available with the employer. For example, employer can select the final payout, whether to select to give in form of the equity or in the form of the cash. Otherwise, employee may have a choice to exercise the benefit either in the form of equity or in the cash. The last type of the benefit is a employee stock purchase scheme, which is also called as a ESPS plan. This is a plan where company issues the shares directly on the grant date itself to the employees at a price lower than the market price of the share, but such shares will be restricted for some lock-in period, because as per the Companies Act, ideally we cannot issue the shares lower than the fair value of the shares. But as part of this ESPS scheme, we can issue the shares lower than the fair value of the share, but they will be subject to some lock-in period. For example, the lock-in period is 1 year as per the SEBI regulation 2021 for this kind of plan. If you see various organizations, the ESOP plan is the plan which is maximum prevalent in India and abroad as of now. So our main discussion will focus on the ESOPs. But yes, when we consult to the companies, we should be aware about all the different type of plans. Now, what is the terminologies in the ESOP and what is the life cycle of ESOP, you can say. So the first one is the grant of option. Whenever company comes up with the ESOP scheme, after that they grant the options to the employees. So granting of option requires, first they require the ESOP scheme, then they grant the options to the employees via the grant letter. Grant letter is kind of an agreement between the company and the employee, which mentions the key details like how many options are given to the employees, what is the exercise price, when it will vest. Vest means when employee will be eligible to purchase the shares. So this will require the vesting of option. So for example, company have granted the option on this date, let's say 1st April 23. Okay, and vesting period can be 2 years time period. So in this period, employee have to stay in the organization. Then company can also attach certain vesting conditions. So vesting conditions can be service condition, that employee have to stay in the organization. There can be performance condition. So this performance condition can be further broken down. Let's say performance of the company, that company revenue should grow from current 100 crore rupees to 150 crore rupees over this vesting time period. Then only employee will be eligible to exercise the option, then only he will vest the benefit. So it can be a performance of the company. Further, this can be a market condition also. For example, company can put a condition that currently share price is 200 rupees, but ESOP will vest only if the share price will jump from 200 to the 250 in the future years of this 2 years time period. So company can have different vesting conditions in the scheme. First, it is a service condition. Then we discussed about the performance condition. Performance condition can be linked to the company for company's non-market condition and the market condition. We can also have the performance of the individual. For example, individual's rating should be above 4 or some other identifiable measure which can be identified based on their KPIs, key performance indicators, that how individual is performing and adding to the growth of the company. So all these are called as a vesting conditions. Once vesting condition is satisfied, like service is also completed, performance is also completed, then option will vest. So till this date, employee was only option holder, but now once the vesting is done, employee can exercise the option, which means now employee needs to pay the exercise price, which is known as the strike price, or you can say predetermined price. So this is basically predetermined exercise price, which was decided on the grant date. So this amount employee needs to pay as a exercise price and purchase the equity shares from the company. So company will issue the equity shares to the employee, and now he will become the equity shareholder on this date once employee exercise the option. So usually what happens, this exercise need not to be done immediately on the vesting date. Company can specify some exercise period. Like April 23, they granted the option. 25, it vested because 2 years vesting period. Company can give, let's say, 5 years to the employee to exercise the option. They can tell that within 5 years, you can come anytime and exercise the option. So that's how exercise period can be defined by the company at any point in time after the vesting period. But this has to be defined in the grant letter itself. So all these terms and conditions will be there in the grant letter. The key component of grant letters we will see in the later part while we discuss more on the ESOP implementation stage. Now, once employee has become the shareholder, they have exercised the option. Now they are eligible for the dividend on the shares because now they are the shareholders. Earlier, they were not eligible for any dividend or any other benefits on those shares. Now, the company can also decide any lock-in period on the such options which have been granted. For example, company can put a condition that whenever you exercise the option, it will remain in lock-in period for 2 years or 3 years, or they can say no lock-in period. So it is up to the company to decide any lock-in period once they exercise the option. So this is a broadly the life cycle of the employee ESOP plan. And let's say whatever is the lock-in period, if any, after that employee will be free to sell the shares to anyone or transfer it to anyone. Because as per the company's rules and the SEBI regulation, the options are not transferable. Like let's say company have granted the ESOP options to the employee named Mr. X. So Mr. X cannot transfer those options to Mr. Y or any of the relative or anyone. They cannot transfer the option to anyone. But one option will become the shares. After the exercise, they will be treated as a normal equity shares and they can be transferred to anyone. Now let us discuss the ESOP implementation key points. That let's say if company wants to come up with a ESOP plan, then what are the key steps required in that? First, we should be aware about the regulatory norms which are present in the India. for the Indian companies to launch the ESOP plan. The first one is the section 62(1)(b), which mainly says that if company comes and launch an ESOP plan, then we need to follow the rule 12 for the mainly the private companies and SEBI regulation for the listed organizations. Now, what are the key points given in the SEBI regulation and this rule 12 of the companies rules 2014? It says that the minimum vesting period has to be 1 year. That employee needs to minimum render the service 1 year time period. Before that, they cannot vest the benefit. But there are certain exceptions to the 1 year also, that in case death happens before this 1 year time period, then all the granted options, they will vest immediately and the nominee of the employee can exercise the option. So death is one exception. Another exception is merger and acquisition. So let's say employees have served 7 months in this organization, and after that the company goes into the merger. As part of the merger scheme, the new entity, they also grant the option to the employees of the previous organization. So in that situation, they can consider only 5 months. Excuse me. So the new entity can consider only the 5 months time period, which is the balance time period from the 12 months time. So this is about the vesting period. Further, the regulation says that company is free to decide the lock-in period. So there is as such no minimum lock-in period, there is no maximum lock-in period. Company is free to decide the lock-in period. The next point, which is mainly covered in the regulation and the company's rules, is regarding the resolutions. It says that company, whenever they comes up with the ESOP plan, they require the special resolution from the shareholders, and it will require 3 types of special resolutions. First one is employees of the own entity, that you want to grant the ESOPs to your own employees. Otherwise, you want to grant your options to the subsidiary employees or your holding entity employees. The third special resolution will be required if you want to grant the option to the employees who have more than 1% equity options you want to grant to them. For example, your total share capital is 10,000 options, and you want to give any specific person more than 1% of that. So in that situation, for that particular identified employees to whom you want to give more than 100 shares, which is 1% of the capital, you need to take the special resolution. So these are the 3 types of the special resolutions required by the regulation. And these regulations says that company needs to follow the accounting as prescribed by the Ind AS or the accounting standard ICI guidance note, whichever is applicable to the organization. For listed company, there are various other regulations in the SEBI regulation. For example, they need to take the in principle approval of the stock exchange before filing for the grant date, and at the time of taking this in principle approval, they need to also give the merchant banker certificate and the secretarial auditor certificate that ESOP scheme is into the compliance with the SEBI regulation 2021. Now, after coming from the regulation aspect, let us come to the accounting aspect. The accounting of the ESOP is to be done either as per the guidance note issued by the ICI. The latest version is the guidance note issued in the 2020. If company is following the Ind AS, then Ind AS 102 is applicable. In case of IFRS accounting, it is IFRS 2, and US GAAP, it is AC 718. Today, our major focus will be on the Indian standards while we discuss. But anyways, the Ind AS 102 is in line with the IFRS 2. So this is a broad steps if you want to do the ESOP implementation for any client or any of the corporate company. So let us consider first, this is a case of the listed company. So first step is to identify the problem statement of company to get an idea for the ESOP to the company. And they can again give the ESOPs to their own employees, to the employees of the group entities as well. So at this stage, once company have the idea about ESOP scheme, they need to frame ESOP scheme. This ESOP scheme needs to be ideally designed by the nomination remuneration committee in case of the listed organizations. In case of unlisted organization, it is done by the board. And this scheme has to be done as per the SEBI regulation, because in the SEBI regulation, they have given various points which needs to be addressed in the ESOP scheme, like what is the minimum vesting period, what is the maximum vesting period, what will be the formula to calculate the exercise price, how the exercise price will be determined, what will be the accounting treatment, what is the treatment on the deaths or the resignation of employees. So there will be various points which needs to be addressed in the ESOP scheme as per the SEBI regulation or the Rule 12. Once this NRC committee prepares the scheme and approves the scheme, it is further approved by the board in the board meeting. The next step will be approval by the shareholders. So this will be done either in the AGM or the EGM. While this agenda is given for the approval by the shareholders, it needs to be supported by the explanatory statement. So this explanatory statement will be kind of a gist of this ESOP scheme, which is in the form of the FAQ, where around 20 questions are there which needs to be answered in this FAQ. The next one is the in principle approval of the stock exchange, that once shareholders have approved the scheme, then company can file to the stock exchange BSE and NSE for the approval of the in principle approval, that whenever company grant the option and later on employees exercise the option, they will list the shares on the stock exchange. So for that purpose, this in principle approval is obtained from the stock exchange. While obtaining this in principle approval, again, the SEBI regulation have given the checklist which needs to be submitted to the stock exchange, and the stock exchange also hosted on their website what are the documents they require along at the time of filing for this in principle approval. For example, they will require this ESOP scheme copy, the resolution copy, agenda copy, whether explanatory statement is there or not. There is one 10B regulation copy which is required. Then they will ask for the certificate from the secretarial auditor and the merchant banker that ESOP scheme is into the compliance of the SEBI regulation. Once this in principle approval is obtained from the stock exchange, then only company can grant the ESOPs to the employee via issuing the grant letters. So again, this grant of ESOP will be done either by the NRC, which is you can say nomination remuneration committee, or by the board as empowered in the ESOP scheme. Then once they have been granted ESOP, the vesting of ESOP will start. And then once vesting is done as per the vesting period, exercise of ESOP can be done and the lock-in, if any, and then employee can sell the share. So this is a typical chart for the listed company where they want to implement the ESOP scheme. Now let us say a company is an unlisted company, then what they are required to do in addition, or what is the main steps which will be reduced from this. So let's say if it is an unlisted company, then SEBI regulation will not come into play. Instead of that, companies rule 12 will come into play. And this in principle approval of the stock exchange is not required. These are the key changes in case of unlisted company in the form of the ESOP implementation. But what will happen when you do the accounting for the unlisted company? At the time of accounting, the accounting standard requires us, or you can say the guidance note, or you can say the Ind AS 102, it requires the company to have the share price report on the grant date. That what is the share price of the company on the grant date? It is required for the accounting purpose. So such report is usually obtained from the registered valuer or the merchant banker for the share price report. So now let us discuss about what are the different type of employees who can be covered in the ESOP scheme and who can be not covered in the ESOP scheme. For example, we can cover the employees of holding company or our own company, subsidiary companies, or even foreign employees also can be covered in the ESOP scheme. We can also cover the directors, whole-time directors, they can be included, but whom we cannot include. So let's say in the ESOP scheme, we can't give any ESOP to them. The next exclusion is any director who is holding more than 10% of the capital. So if any director is already holding more than 10%, then we cannot grant any ESOPs to them. Further, we cannot grant any ESOP to the promoter or the person belonging to the promoter group. So this is the main list of the ESOP inclusions and exclusions that to whom we can and we cannot give the options. Now let us discuss what are the key points which we need to cover in the ESOP scheme, or you can say ESOP master plan. So firstly, we need to understand that whenever we are preparing this ESOP scheme is kind of a master plan which will cover the broad principles and the definitions, which will be applicable to the all employees to whom we grant the options under this scheme. And company other than this ESOP scheme also need to give the employee specific grant letter. So grant letter will be specific to them. Scheme is general document which is applicable to the all employees to whom we have given the ESOPs. So in that view, we need to prepare this ESOP scheme. This will cover mainly the key terminologies and the maximum and minimum limits on the all items. For example, company first need to put the ESOP pool size, at how many options they want to grant overall under this ESOP pool. So basically, what is the ESOP pool? Let's say you have total 10,000 share capital as a number of shares, and let's say company decides that they want to create a ESOP pool for, let's say, 1,000 options, which is total 10% of the equity existing capital. So the ESOP pool of 1,000 options, they need to mention in the ESOP scheme. So how the ESOP pool works, that overall ESOP pool is to be utilized not within 1 year, but within the overall time, that in the time when this ESOP scheme is into place. So for example, let's say company grant the options. Out of that 1,000 options, let's say we have granted the 200 options in this year, but next year company again grants 500 options. So total options granted are 700 from this pool. But now let's say 300 employees leave the organization before vesting. So now the 300 will be again released from the pool, and balance available in the pool will become 300 plus earlier remaining 300, total 600 can be again granted to other employees. So that's how the ESOP pool works. We need to give the definition of employee. Company can grant this period is required, or what is the criteria to give the ESOP. So that criteria we need to give in the ESOP plan, whether the settlement will be in the form of the equity or the cash. It is a equity settle plan or it is a cash settle plan. How the fair value accounting will be done. What will be the grant date? Like who will be authorized to grant the option? Whether board will be authorized, directors will be authorized, who will be authorized to grant the options. Then we need to put in the ESOP scheme about the corporate action, that what will happen in case of mergers and acquisition, that how ESOPs will be treated, what will be the vesting conditions, whether any performance condition is there or service condition is there. Again, whether the NRC is authorized to mention the vesting conditions in the letter, or company have defined the same vesting condition for all employees. What will be the minimum and maximum vesting period? Like minimum vesting period has to be 1 year as per the regulation, and maximum there is as such no limit. So what is the vesting period, minimum and maximum under this scheme we need to put. Then what is the performance condition? Whether any performance condition will be required or not. Whether what is the minimum service condition required. Then again, treatment on the death and resignation is very important. For example, in case of death, what happens? Whenever the death happens, all the vested and unvested options remaining, everything will be considered as a vested on the date of death. So it is like an insurance plan for that person, where all the granted options will be considered as a vested on the date of death. Now in the ESOP scheme, company need to put that in how many days the nominee needs to exercise such options. For example, whether they can exercise in the overall remaining exercise period, or let's say in the next 1 year, or what is the time frame to exercise the option in case of death. Similarly, in case of resignation, what will happen to the vested options which are not yet exercised on the resignation date? For example, employee have rendered the service which was required for the ESOP, and he has already vested the benefit, and now he is leaving the organization. But since there was an exercise period available to the person, he has not yet exercised the option. He is waiting for some time period to exercise the option. So now what will happen to that? Whether such whether such vested but not exercised option, they will lapse, or employee will have further time period to exercise the option. Usually, companies keep a policy that on the resignation, they will lapse if they have not yet exercised before the exit date, or sometime company give maybe 2 or 3 months time to exercise the option. In some of the cases, it has been also seen that company put a condition that employee can exercise the option till the remaining exercise period as well. Then we need to also put the what is the overall exercise period for the ESOPs. Like once we have vested the benefit, what is the overall exercise period? This exercise period can be linked to the vesting date. It can be linked to the grant date as well. Then what are the buyback provisions? It is very important in case of private limited companies, where companies prefer to put the buyback of this specified security is ESOPs, that whether companies, private companies, company can also put a condition that what will happen to the exercised option on the resignation, whether employee can carry such options with them or carry such shares with them which are already exercised, or they need to sell it to the promoters. Then we need to put the lock-in period, whether it is 0 time or any time period. So all these things needs to be given in the ESOP master plan, and within this purview, the grant letter is prepared. Now this grant letter will be employee specific. For example, in the ESOP scheme, you may have given the minimum and maximum time period. For example, minimum time period 1 year, maximum time period, let's say 7 years from the grant date as a vesting period. But now you want to grant the options to your different employees. So you can prepare the different grant letters for the different employee. For example, for some class of employees, the board may decide to give a vesting period of, let's say, 3 years. For some, they can decide 5 years. But ultimately, it has to be within the scope of the ESOP scheme. It cannot be outside the ESOP scheme. This grant letter has to work number of options which are granted, and then they will be converted in, which means 100 options will be converted to 100 equity shares. Then we need to put the grant date, which is very important because accounting will happen as per the grant date. What is the exercise price? That what is the price employee needs to pay to get the shares on the exercise date. This exercise price, as per the SEBI regulations, it cannot be less than the face value of share. Let's say the face value of equity share is 1 rupee, or you can say 10 ESOP at free exercise price that you cannot give. There has to be some exercise price because you cannot yeah, I guess the network got disconnected. Whether it is connected now? Okay. Let me reshare the screen. I think for a fraction of second it got disconnected. So now the screen is visible. Okay. Yeah, it looks like some again connectivity issue in the internet. I have changed the internet. Yeah, okay, maybe let me also turn off my video. Yeah, yeah, I'm just turning off my video also for the, yeah, yes. Sorry for the technical interruption. Yeah, so we were discussing about the vesting schedule, that in case of this grant letter, we need to put this vesting schedule which can have the graded vesting. For example, the employees will vest these 100 options in the 3 years, but not fully at the end of 3 years. It will vest in 3 different tranches, like 30%, 30%, 40%. Or it can be equally in the 3 years. Or we can give the 2 years vesting period as a 50-50%. Further, we can have the vesting schedule like 1 year, 1.5 year, 2 years. So any vesting schedule is okay. Only thing, the minimum vesting time period has to be 1 year. You cannot give any vesting which is less than 1 year as per the SEBI regulation and the company's rules. Then we need to put the requirement of the TDS, because whenever we exercise the option, it is considered as a taxable event. So perquisite tax, it is considered as a perquisite, and we need to deduct the TDS as a salary. The vesting conditions, whether there is any performance condition of the employee or the company, that we need to specifically mention in the grant letter. So employee will be aware of that. For example, performance condition like rating of 4 plus, or let's say performance of the company, the turnover growth should be, let's say, 10% or 20%. So such kind of performance condition we need to put in the grant letter for the individual employee. Then service condition, which is linked to, you can say, the vesting schedule. Vesting ratio we have already discussed. It can be cliff vesting. Cliff vesting means, you can say, bullet vesting also. For example, that overall options will vest once you complete the 3 years of service. So if you leave the organization before 3 years, let's say you leave the organization at 2.5 years, so you will not receive any benefit, but benefit will be received only if full 3 years is rendered as a service. So this is called as a cliff vesting. But another is the graded vesting, where the vesting will be done in the 3 different tranches or 2 different tranches. Then lock-in period, which is specific to the employee, it can be described. For example, company can grant the options where some of employees will have the lock-in period, some of employees may not have the lock-in period. That is also possible. Then we need to clearly mention in the grant letter that transferability of options is not allowed, because options cannot be transferred to the another person. This is broadly the taxation aspect for the employees, because whenever we consult to the companies and we discuss with the employees, they will be always concerned about the taxation. So we need to be aware of this taxation aspect, that on grant date there is no taxation, because they are only getting the option. They are not getting any equity shares or any benefit as such. So on grant date, there is no taxation to the employee. And even on the vesting date also, there is no taxation. The taxation will come to the employee once they exercise the option. So on the exercise date, we need to calculate the perquisite tax. So how this perquisite value is calculated? This is considered as a share price on the exercise date less exercise price. That is, if it is a listed shares, then the stock exchange where we have the maximum trading, that stock exchange share price we need to consider as a share price on exercise date, and exercise price will be as per the grant letter. Now let's say this entity which is not a listed entity, in such situation the share price on exercise date will be calculated as per the merchant banker, as per the DCF valuation method. So here the role of merchant banker will come. The next taxation to employee will happen in case of transfer of shares, that whenever they sell or transfer the such shares, then capital gain will apply to the member as a shareholder. It will be a long-term capital gain or short-term capital gain based on the holding period. Now to the startup companies, the Finance Act 2020 had given the benefit that on exercise date, this taxation is deferred. So this deferral is eligible only for the eligible startups who are covered under the eligible startups. In such case, those employees are not required to pay this salary income tax on the exercise date. This is deferred till the time when they sell the shares or they leave the company, or after the 5 years, they need to pay the tax if they don't sell the shares till that time. So this is a benefit given to the startup companies to promote the startups and to give the non-cash benefits. So that's why in the eligible startups, this ESOP is a very common and a very popular benefit, that they don't need to tax the employee on the exercise date, but directly it is deferred. And such deferral will depend that if they are continuing with the company as a long-term employee, then still it can be deferred up to 5 years. So that's why the startups are preferring the ESOPs as a benefit to the employees. This is all from the aspect of the ESOP implementation. Now let us cover the ESOP valuation and its accounting part. When we talk about the valuation, the question will come to our mind that what are the different type of valuations will be required in the ESOP. Like if the company is a listed entity, then company share price we already have from the recognized stock exchange, for example, BSE or NSE. So that share price we select from the stock exchange price. So company share price, if it is a listed company, we have from the stock exchange. If it is an unlisted company, then it is taken from the registered valuer or the merchant banker. The second valuation is required for the fair value of the option. So this is basically a call option. So this fair value is required for this option. This is required under the Index 102 as well and the guidance note of ICI as well. Why it is required? The accounting standard says whenever we are granting the option to the employees, they are getting an option and it have some intrinsic value and the time value of money. So that's why we need to calculate the fair value of option. But what happens in case of the guidance note of the ICI, which is to be followed by the entities which follows the accounting standard, it allows the entity to use the intrinsic value method. But at the same time, they are required to give the disclosure as per the fair value. That's why they are also required to calculate the fair value of option. And I said this is required to the all companies, irrespective of accounting standard following organization or the Ind AS following organization, because in Ind AS the accounting is mandatory on the fair value of option. There is no choice of the intrinsic value. Now the question will come, what will be the date of valuation? That if we have to do the fair value of the option, then what will be the date of valuation? So it will depend on whether our stock option is a equity settled plan or the cash settled plan. Because in case of equity settled plan, the fair value is to be calculated on the grant date. And whatever grant date value, fair value is coming, it will become fixed for that particular grant of the options to the employees, that we will be amortizing over a time period. But this grant date fair value will not change even if the share price goes from 200 to 500 or 200 to 50 rupees. this grant date fair value, whatever we have calculated, that we need to amortize in our P&L, that will not change in case of the equity settled transaction. So this date is very important in case of equity settled transaction. Now, in case of cash settled plans, where company will settle the amount in the form of cash, so it is kind of a financial liability of the company. And the accounting standard says that in such situation, we need to calculate this fair value on every reporting date till the settlement date. So here the fair valuation will be required every reporting date. For example, the vesting period is 3 years. So this fair value will be calculated again and again on every reporting date. For example, if company is doing the yearly reporting, then every balance sheet date, they needs to calculate this fair value, and ultimately on the settlement date also. Based on that, the expense recognition will be done in the books of accounts. Now the question is, what are the different methods which can be followed for the option valuations? So what we are discussing over here is the fair value of option and not the company share price valuation, because company share price valuation, it is usually done by the registered valuers or the merchant bankers, which may be a DCF method, net asset value method, or some other price comparables, because there are various different methods. So I don't want to go into that, because the accounting standard says it has to be a fair value in case of unlisted company. Now, in case of this fair value of option, the accounting standard have suggested 3 different methods. The first method is the Black-Scholes model, which is also known as BSM model, and the another model is the binomial model. In binomial model, it is also called like a tree model, where we create the probabilities of up and down like this. For example, share price currently is X amount. Then if it goes up, what will be share price? Then what is the value of the call option over here? What is the value of call option over here? Then in the next time period, how it will move like this. So like this, the combining tree is created, and then the option value is calculated in the binomial model. The third model is the Monte Carlo simulation model. This model is mainly used where the ESOP scheme have certain kind of guarantees or certain kind of limits. For example, ESOP scheme may have a guaranteed minimum benefit, that this much benefit we will give to the members, or they may have certain kind of caps on the benefit. For example, the final benefit is, let's say, the cash settled plan, but it will be limited to a particular price and not to as per the ultimate final share price. So in such scenario, we need to use the Monte Carlo simulation model, because these models will not be able to capture this variability of the guarantee and the different flexible benefits. But if you see in the practice for the listed companies and the unlisted companies, the maximum organizations follow the Black-Scholes model. This calculator you may find online also, or the formula I have given over here. So let us discuss the parameters to the model. In the Black-Scholes formula, this formula I have given here is the standard BSM formula, which is without dividend. If you remember from your CA final finance management exam paper, this we have studied over there. So it is already studied by all our chartered accountant friends. So in this, what we need to consider, first one is the key parameter is the stock price on the date of valuation. So here the date of valuation you will check as per the equity settled plan or the cash settled plan. And such stock price will be, if it is a listed company, you already received from the stock exchange, otherwise from the independent valuer. The second key parameter is the strike price of call option, or you can say exercise price, which is given in the grant letter of the employee. The next key parameter is the risk-free rate of return. This risk-free rate of return is the GSEC on the zero coupon yields. It is prescribed in the accounting standard that we need to take GSEC on the zero coupon yields. The next important factor is the expected expiry time. So this is, you can say, expected term of option. So this expected term of option will be the time period from grant date to the expected exercise date. For example, company have given certain vesting period. For example, in our earlier example where grant date was 23, the vesting date was 2025, and last exercise date was 2030. So this was our example. So overall, employee have total 7 years time period to exercise the option. So the contractual obligation period is 7 years, but we need to check and discuss with the company that what is the expected time period when employee tends to exercise the option in this time period, because overall 5 years is there to exercise the option. So let's say we call that employee will exercise at the midpoint, for example. So in that situation, the expected term will be, so let's say this will become 27.5, the last exercise date, and the 4.5 will become your expected term. So that's how we need to calculate the expected expiry term in the years. This current time in T years, it is mainly applicable if you are doing the valuation under the cash settled plan, where you have some valuation date which is after grant date. So we need to reduce the time which is already elapsed. But in equity settled plan, this factor is not relevant. The next parameter is the annualized volatility of the stock. The standard says that this volatility of the stock we need to take based on the implied volatility of the option if it is available. But in market, we don't have such long-term options available. So what we are required to do as a second step is to calculate the historical volatility from the share price returns. And since this Black-Scholes model follows the log normal distribution, we consider that share price returns also follow the log normal distribution and need to calculate the volatility of the stock price returns. That volatility will be used as a parameter in this Black-Scholes model. The last parameter is the annualized dividend yield. This is mainly the dividend which is available in the past. Now the accounting standard says this assumption of risk-free rate of return, annualized dividend, and the annualized volatility. These three assumptions, they needs to be consistent with the expected expiry term. So this particular aspect of the valuation parameter is very important. For example, if you select the expected time as a 4.5 years, then your risk-free rate will be 4.5 years maturity period GSEC rate. In case of volatility, you need to go back to about 4.5 years. Similarly, for dividend yield, you need to check the average dividend annualized yield for that much time period. I hope it is clear to all our friends that how we need to select the parameters for the ESOP valuation. So this is again some literature I have given that how to select these key parameters. What is the broad pointers have been given in the Ind AS 102 as part of the appendix. So some of them we have already discussed as part of our discussion on the previous slide. Like share price needs to be as per the stock exchange value or as per the independent valuer report, and the exercise price of option, it is given in the grant letter, and it cannot be less than the face value of equity shares. Then this expected number of period to exercise the option, this we have calculated. Again, the appendix B have given enough literature to check how we can calculate this expected time period, whether it affects by the type of employee, what is the overall contractual time period, and so on. Similarly, the key point over here is regarding the volatility. The standard says, since we are taking the historical volatility as a annualized standard deviation, we need to ignore the some rates which are where the price were very extraordinary volatile, which you are not expecting to be repeated in the future. So that particular time period where share price was very volatile, that you can ignore while considering the volatility rate. Now, once we have calculated the swap fair value, this we need to amortize for our accounting purpose in the books of accounts. So the accounting standard says we need to amortize the ESOP expense on the straight line basis over the time period when options are expected to vest. For example, the total time period is 2 years. So we need to amortize in the 2 years time period the ESOP expense. But at the same time, it says that if we have granted the graded vesting ESOPs, then what we need to do, we need to consider such graded vesting options as the different tranches. So we need to use the separate grant approach for the graded vesting and amortize the expense over the respective time period of that particular tranche. So for example, let's say we have granted the option with the graded vesting period of, let's say, 3 years. So it is a vesting period of 1 year, 2 year, and 3 years. So this option we will amortize over one time period, 1 year time. This we will amortize over 2 years, like 50% and 50%. And the options which have 3 years time period, we will amortize over the 3 years time period, 1/3, 1/3, and 1/3. So that's how we need to amortize the expense on straight line basis. Further, it says that we need to amortize the expense for the options which are expected to vest. So let's say we have granted 100 options to the employees, but there can be some future attrition rate that employees may leave by this date, or this date. So we need to consider only options which are expected to vest on these dates. That only we need to consider for the ESOP expense. And standard further says, as we progress with the time, we can do the true up or true down in this number of options, because it is based on the estimations, and actual will come to know when you progress in the next years. So that time you can adjust your next year expense by calculating the cumulative charge. And from that cumulative charge, you reduce the previously accounted expense and then account for the balance expense. So this is mainly on account of the how we need to amortize the ESOP expense. Now let us see some of the accounting entries. So let's say a company have granted 10,000 options which are equity settled to CEO who is a KMP in the organization with a total vesting period of 2 years. So here it is a total 2 years vesting period. It is not a graded vesting. It is a bullet vesting of 2 years, or you can say cliff vesting, and fair value of option is 20 rupees per share. So total fair value which we need to amortize is 2 lakh rupees, which is 10,000 multiplied by 20. But total vesting period is 2 years. So we need to amortize 1 lakh rupees expense in both the years. The accounting will be, we need to charge this as an employee benefit expense, and credit will go to ESOP reserve. That's how the accounting entry will work. The ESOP expense account debit in the P&L to ESOP reserve, and this will be shown in the balance sheet as a other equity. Many times it has been observed that in some of the companies, they have disclosed this ESOP reserve under the long-term provisions, which is not appropriate, because long-term provisions you can show only for the cash settled plan. But for equity settled plan, where you are going to give the equity as a settlement to the employees, then this ESOP reserve will be disclosed as part of other equity only and not as a long-term provisions. Now let us discuss that what is the accounting treatment though for those vesting conditions. These vesting conditions we have discussed earlier. Like what we had discussed, that we had the vesting conditions where first one was the service condition, that employee has to stay in the company. The next one was performance condition, which is broken down into non-market condition and the market condition. The market condition is, for example, the share price should move from 10 rupees to 30 rupees or whatever we can call it. So the standard says for service condition and the non-market performance condition, for both these, we need to allow for these vesting conditions in the options which are expected to vest. So, and further, every year we need to do the true up or true down for these conditions. For example, earlier we were expecting that out of 100, 90 employees will continue the vesting period. They are expected to vest. So we were booking the expenses based on the 90 employees. But as per the latest update, if company expect that, let's say only 85 will vest, or let's say 95 will vest, so they need to true up or true down the ESOP expenses to allow for that. But in case of market vesting condition, the standard says such market performance condition we need to consider in the fair value of option and not in the number of options. And this fair value of option is calculated on the grant date, which is the first date of that ESOP. So such market performance condition we need to allow for only in the fair value of option. Then since this fair value of option is considered only on the grant date, any true up or true down is not done due to market performance condition. So for example, whether this market performance condition is finally meet or not meet, that will not change your overall ESOP expense, because in these two conditions, you are allowed to do the true up and true down because they are considered in the number of options. But in case of market performance condition, at the final date, if the market condition is not met, so although the ESOP will not vest to the employee, but as per the requirement of the standard, company will be still required to continue to book the expense. They need to book the P&L of the fair value which was determined on the grant date. They cannot change that fair value. The last condition over here is the non-vesting condition. So this non-vesting condition is something which is not in the hands of the employee or the employer. For example, company can put a condition like inflation should be less than 5%, something like that. So again, the standard says such type of vesting condition we need to put in the fair value of option only and not in the your number of options. So this is about the treatment of vesting conditions. Now let us also discuss about the accounting for the modification and cancellation, because it may be possible that company may modify the ESOP plan after its launch. So how this accounting needs to be done, let us discuss that as well. So the accounting standard says, both in the Ind AS 102 and the guidance note of the ICI, the treatment is same in this situation of the modification and the cancellation. It says that whenever we modify the ESOP plan, we only need to account for the impact of modification if it is increasing the fair value. If it is decreasing the fair value, then we don't have to account for such reduction, because as a minimum, we need to account for the expense, which is the fair value calculated on the grant date. You cannot book any expense which is less than the grant date fair value. Further, how this incremental fair value is calculated, this is given under the Appendix B to the Ind AS 102. So this Appendix B says that on the date of modification, we need to calculate the fair value of option before modification and after modification. And the difference of that amount will be called as an incremental fair value. That incremental fair value we need to amortize over the remaining vesting period. So let us see the example in this as well. So let's say company have granted the ESOPs on 1st April 21 with an exercise price of 100 rupees, and the total vesting period was 3 years. When company have granted the option, the share price was 150, so the option was in the money option, and it was attractive to the employees. But after first year, in the second year start, the share price goes down to 70 rupees. And now entity feels that this share price is not expected to come back soon. So due to this ESOP is now not attractive to the employee, because market price is 70 and exercise price they have as per terms and condition is 100 rupees. So in that situation, ESOP will lose its interest, because now it is no longer a retention tool, because employee will not exercise this option. It is now a out of the money option. So in such scenario, company may think of doing the modification in the ESOP plan, where they can say, let's say this exercise price of 100, now we will reduce to 40 rupees. So now it will become attractive to the employees to continue in the organization. So the standard says, on this date of modification, you consider all your parameters and calculate the fair value before modification and after modification. Like before modification, your exercise price was 100. After modification, your exercise price is 40 rupees. And your other parameters like share price, risk-free rate, etc., everything on the date of modification. So the difference of pre-modification and post-modification will be called as an incremental fair value, that we need to amortize over remaining time period of 2 years, because 1 year is already left. In second year and third year, you will amortize that additional cost. And if the option is already vested on the date of the modification, in such scenario, for the vested option, we need to immediately charge the money in the P&L account. This is what Appendix B says for the modification accounting. Now let us discuss the cancellation of ESOP accounting as well. So let's say any time in the ESOP life cycle, if company feels that they are required to cancel the ESOP by obtaining the confirmation from the employees and passing the special resolution, etc. Let's say they are canceling the ESOP plan. Then what will be the accounting treatment? The accounting standard says one line very important, that you cannot book the ESOP expense which is lower than your grant date fair value. That you need to continue to book. Further, in the para 28 of the Ind AS 102, similar paragraph is there in the ICI guidance note as well. It says that cancellation of plan we need to account for as an acceleration of vesting. So this acceleration of vesting means we need to immediately account for all the expenses as an acceleration of vesting and book the expenses immediately, which was supposed to be booked in the remaining vesting time period. So company may have thought in their mind that it will be reversal of expense, but it will be booking of future year expenses also immediately. So accordingly, company need to take a call very carefully whether they want to cancel the ESOP plan or not. And if any settlement is done for the payment, then such settlement price will be consumed from the ESOP outstanding reserve which we have. The accounting entries will flow like this. But first, we need to pass the accounting entries for acceleration of ESOP expense, like P&L account debit to the ESOP outstanding reserve. And then from ESOP outstanding reserve, we will pay the money, any settlement price if we are paying. And if the payment is more than the share value on the repurchase date, then such excess will be accounted for in the P&L. Then lastly, whatever balance is there in the ESOP outstanding reserve, that we will transfer to the general reserve. This is all about for the ESOP cancellation and modification. Now, let us shift to the group share-based arrangements also, because whenever we are drawing the ESOP plan, or let's say we are doing the ESOP accounting, we need to keep in mind certain things for the group share-based arrangements as well. For example, holding company is a listed company, so their shares are freely tradable. So they may be giving their shares as a ESOP to the employees of the subsidiary company ABCD, let's say. So what will be the accounting treatment in such scenario? Whether they are covered under the Ind AS 102 and the ICI guidance note. So now the point is, as per the old ICI guidance note, which was 2005, such group share-based arrangements were not covered in that. So they were not accounted for as an expense in the books of the subsidiary. But now, as per the latest guidance note, which is 2020 guidance note, such group share-based payment arrangements are also considered in the ICI guidance note as well. Let us see what the standard says about this. So basically, here is the example that holding company gives the ESOP to the employees of the subsidiary company. So how the accounting will happen for the parent company and the subsidiary company. So on this, the para 43B of the Ind AS 102 is very relevant. This applies to the entity which receives the goods and services. So let's say in our example, subsidiary entity is the organization who is receiving the goods and services. So it says that they will book it as an equity settled plan if any of these two conditions are met. So we need to check these two conditions. The first condition is award granted are its own equity instrument. Now we are talking about the subsidiary company. So question is whether whatever employee receive, it is a award of the subsidiary company? Answer is no, because it is a award of the holding company. So this condition is not satisfied. Now we need to check this condition, that whether this entity, which is your subsidiary entity, whether they have any obligation. If they don't have any obligation to settle this transaction, then they can record it as a equity settled transaction. Now in this situation, the obligation is lies on the holding company to give the equity share. The subsidiary don't have any obligation, so this condition is met, and they will record as a equity settled transaction. Further, the para 43C speaks from the view of the entity which settled the transaction. Like here, the holding company is the one who is settling the transaction. So for that purpose, it asks only one condition to qualify as an equity settled transaction. The condition is to check whether the settlement is in the form of the own equity instrument. And for the holdings perspective, they are making the settlement in the own equity. So they will also consider it as an equity settled transaction and account for the expenses accordingly. Further, there is a para 43D in the Index 102, which says that even though there can be some intra-group recharge arrangement for some reimbursement, still we need to follow the classification as per the 43B and C. So such reimbursement model will not change the classification of equity settled and the cash settled. Here I have given one summary that where award is given by parent or subsidiary, and what is given, whether award is given of the shares of parent, subsidiary company shares, or cash is given, then how the classification will be done in each of the three financial statements of the consolidation, standalone, of the parent and the subsidiary. Because if you remember, the measurement date will depend on the type of transaction, whether it is a equity settled or the cash settled. And this bifurcation you can check based on these conditions of 43B and 43C, which is discussed on the previous page. So these are the accounting entries. Now let's say we are also in the similar concept of considering the situation that although the option was granted by the holding company, but now employees transfer to the subsidiary company. Or let's say employee was already there in the subsidiary company and we have granted the option. So how the accounting will happen? So the subsidiary is doing the accounting as a equity settled plan. So the accounting standard says we need to book the expense where service is rendered. So the subsidiary entity will account for the ESOP expenses in the P&L, and the credit will go to the equity as a capital contribution. In case if company is doing some reimbursement and some payment, then credit will go to that creditor, basically the parent company. Or you can say to bank if the company immediately pays the amount. In case of holding company, they need to create the ESOP reserve because they are giving their own equity. So the accounting treatment will be, if there is no recharge arrangement, then it will be considered as a cost of investment in subsidiary account debit to the ESOP reserve, you can say equity. But if there is a recharge arrangement, then they will debit either to the subsidiary or to the bank if the amount is already received, or you can say receivable. So that's how this accounting entry will happen for the subsidiary transactions. Now let us also discuss some of the key differences in the Index and the ICI guidance note versus the old ICI guidance note. The key difference in the Index 102 and the latest ICI guidance note is only one key difference, that Index 102 requires that accounting of ESOP expense has to be done as per the fair value only and not on the intrinsic value. But ICI guidance note, still they have given the choice to the companies for the accounting policy choice to select whether to take the intrinsic value or the fair value. So basically intrinsic value is calculated very simply. Let's say your share price on the grant date is, let's say, 100 rupees. And the exercise price which you have given to the employees is also 100. That employee is eligible to purchase the share at 100 rupees. So intrinsic value will be 0. So the accounting P&L for the company will be 0 in this case. But fair value of option will come something. It will be non-zero number, because fair value is intrinsic value plus some time value of money, because this 100 rupees of share price can increase in the future or it can decrease also. But since there is a volatility, time value of money, future time involved, there will be some fair value coming, let's say 20 rupees or 30 rupees. So accounting standard says in the ICI guidance note that company is free to decide this accounting policy choice, and such amount will be amortized as per the state line basis, but company needs to give the disclosure as per the fair value as a mandatory requirement. Now, as a brief, the difference between the ICI guidance note 2020 and the guidance note 2005. So the major difference is, in case of old guidance note, the group share-based payments were not covered, but they are now covered. Similarly, employee transactions were only covered under the earlier guidance note, but the new guidance note also covered the non-employee transaction. Like if you purchase any fixed assets or some AMC transactions, so they are also covered under the new guidance note. So these are the key points I thought to discuss in our today's session. I also want to show in the Excel file some numerical example to show how the accounting will happen as a calculation of the ESOP expense from the start date to the end date till the exercise date. But maybe what I feel, can we take some Q&A if we have any questions so far? So then we can show that Excel file, or how we should go ahead, or first we complete that Excel file and then take the Q&A. Jignesh ji and Gautam ji, shall we first complete this Excel file, because I intend to show one calculation in the Excel file. Okay, let us first complete that Excel file as a calculation. Just 1 second. And before that, I would also like to show you that in case you want to see the disclosures, what are given for the Ind-AS 102, or let's say any other Ind-AS, then we have given one link to check the disclosure. This is a link of the ICI's WIRC website, where you can search for any of the Ind-AS you want to search, and then you can click on the view more and you can download the Excel file for the disclosure. So on one click, you can download the disclosure in the Excel file for the listed companies for any particular Ind-AS. That is possible on any Ind-AS. It is available on the ICI's WIRC website. Let me show you that link as well, because it will be helpful to our members in the future.
Hello, everyone.
Yeah, hello, ma'am. Good evening.
Hope everything goes well, and am thankful to all for joining this symposium. Today, this is the 9th symposium, and the next Friday we are going to complete the 10th one. So we'll complete, the 10th in the next coming Friday. I hope everyone is gaining the knowledge with this your young members excellence youth excellence symposium. If you want to take participate, if you want to participate in this symposium as a speaker or moderator, please feel free and reach out to us so that this is an opportunity for all our young members below age of 35, so we can give the opportunity to maximum of our members, the platform to all our young members. So this is our endeavor to serve the best to all of you. And for that, we are organizing this series. So thank you very much. And today this session was on ESOP. So we invited Karthike Kandoi, and I hope you must have enjoyed his session. I also, all amazing moderators, Gautam, Priten, Jignesh, and all. With their support, it becomes really easy to have this kind of sessions. So, and Kartike, your question answers are on.
Yeah, we can take the Q&A now.
Okay. Am I audible?
Yes.
Yeah,
Yes,
Utkarsh,
Yes,
you are
sir.
audible.
Yes, ma'am. Hi, good evening. Thank you, Kartikeya sir, and thank you to the team for giving me this opportunity to ask questions. The first question is how to fixate exercise price for non-cash ESOP from taxation and valuation point of view. Over to you, sir.
Yeah, so for the non-cash transactions, can you repeat the question?
Yes, sir. How to fixate exercise price for non-cash ESOP from taxation and valuation point of view.
Okay, so first of all, the decision of the exercise price as such will have no taxation impact on the grant date. See, because exercise price can be selected any price above the face value of share. So the exercise price has to be minimum the share price, which is the face value of the company, and not below that. And company is free to give any discount from the market value. There is no restriction on that. For example, the market value of share is 100 rupees. So they are free to give the exercise price, let's say 80 rupees or 70 rupees. So how much discount they want to give to the employees, it will depend on how much value they want to pass on to the employees based on the current valuation. So there is as such no maximum discount. So ultimately it will depend on the amount how much company wants to transfer as a wealth to the employee based on the current share price. Yeah.
Okay. Thank you, sir. Thank you. The next question is ESOP or RSU, which is beneficial to an employee?
Yeah. So from employees angle, if we see the person, see ideally the RSU would be more beneficial in the sense the benefit if it is received in the cash. For example, RSUs which are cash settled, because again, see, RSU word itself cannot be generalized. We need to first understand what do they mean by the RSU. Sometimes equity settled plan is also loosely called as a RSU. So if I understand it correctly by the member, then RSU, they must be meaning about the cash settled plan. So if it is a cash settled plan and they have referred it to as a RSU, then employees usually prefer the cash settled plan because they are getting the actual cash on the exercise date rather than just a share. Because in case of equity settled plan, they are getting the equity share on the exercise date and they have to pay the exercise date taxation without getting the actual wealth. The actual wealth they will receive, or you can say the monetary value they will receive once they sell the share or they transfer the share. So usually employees prefer to receive the cash But again, if the employee's mindset is to receive the wealth in the form of the equity, then obviously they will prefer the equity settled option. And if we talk from the company's aspect, then from company's aspect, the ESOP will be better because the P&L charge will be less volatile in case of ESOP, because ESOP have the accounting charge based on the grant date fair value, but cash settled plan will have a accounting charge based on the future share price of the shares, because it requires the remeasurement of the fair value on every reporting date. So that's why companies who prefer less volatility, they prefer the equity settled plan.
Okay, sir. Thank you. Thank you for your detailed reply.
Yes.
The next question is, please help me to clarify very technical, practical problem we are facing to roll out ESOP. We are having two business units in single company. How ESOP can be taken care and kept business units separate and still we justify?
Just 1 second, because the internet is a concern. Just 1 second. Can you copy that question on the chat? Is it possible to copy the question on the chat?
Yes, sir. While I do that, I'll ask you the next question. What is
Yes.
ESOP pool and ESOP trust? If you could just spare 2 minutes on it.
Yeah, so basically ESOP pool is a overall limit within which company can grant the options. For example, overall equity capital is 1 lakh, and usually the ESOP pool which company creates is, let's say, maybe around 2% to 5% or any other ratio based on the how much dilution company is okay to reduce their own holding. Because what will happen, to grant the shares, there are two ways. One way is to issue the new shares. The another way is to purchase the earlier issued shares from the market and give those shares as a benefit to the employee. Within that, the ESOP trust also comes into play. That, let's say, if company wants to issue the new equity shares as a settlement to the employees on the exercise date, then usually what they prefer, they directly issue the equity shares from the company's equity capital and increase in the equity capital, and they issue the shares. The other option is they create a ESOP trust. From that ESOP trust, company first gives a loan to the trust. With that money, the trust will do a secondary acquisition from the market. They will purchase the equity shares of the company from the open market. So there is no increase in the equity share capital of company, because existing shares are only used by that trust. And whenever employee vests the benefit, they want to exercise the option, they go to the trust with the exercise price check and subscribe to the share, and the trust will sell the shares to the employee. And later on, if employee wants to sell back that shares, they can sell that share to the trust also. So now the question comes, why company may prefer to have this kind of ESOP trust? The one reason could be, let's say if it is an unlisted company, then company may want to create this kind of trust to create a kind of a marketplace for the employees, where they may be allowing the trust to purchase back the shares from the employees who have exercised the benefit. So this will in a way provide the marketplace to the employees. And similarly, in case of listed company, why they prefer the ESOP trust? Because otherwise, if every employee comes again and again with the request of exercise of option, then the admin activity may increase, because every time they need to increase the share capital, the issue of share capital, PAS 3, etc. will come into play. So that's why they may prefer to have the ESOP trust. Now just let me go through.
Okay, sir.
Yeah, we are having two business units in the single company. how ESOP can be taken care and kept the business unit separate and still we justify the. Yeah, so as such, there is no problem in that. If even if we have 2 units, see, 2 units are still fine. Even if we have the subsidiary company also, we can give the ESOP to the subsidiary as well. So as such, there is no question. Company can decide the key person to whom they want to give the ESOP within the 2 business units. It may be also possible that they want to give the ESOP only in the 1 unit and not in the 2nd unit. So it will depend on the management philosophy that to whom they want to give this ESOP benefit.
Okay, sir.
Yeah.
One last question, sir. In case of cancellation, why the expenses will be booked for remaining vesting period and why earlier year expense is not reversed?
Yeah, so this question is very important. So this concept was regarding the cancellation of ESOP, that employee is not leaving the organization, but company is closing down the ESOP policy. Okay. So in that situation, the accounting standard says whatever is the total fair value of ESOP, which was determined on the grant date, that you need to continue to book. So that's why it says that in the cancellation of ESOP plan, where employee is not leaving, so there is no failure of the vesting condition. It is the company who is closing down the ESOP plan. So the para 28 in the Index 102 says that it is considered as a cancellation of ESOP, but it is recorded as a acceleration of ESOP vesting. It means that ESOP is vested immediately on the date of cancellation, and then you need to account for the expense. Contrary to that, let us consider a situation that company is not closing down the plan, but employee is leaving the organization. So if employee leaves the organization, so in that situation, we need to reverse the ESOP expense for the portion to which options are not yet vested. Whatever vested options are there, you cannot reverse that expense. That will flow to the general reserve, but we cannot reverse such earlier booked expense of the vested plans. For unvested plans, we will reverse the expense in the P&L account for the expense which was already recognized in the previous period, because we record the expense over the service period. So if employee leaves the service, it means there is a failure to the vesting condition, because vesting condition was he has to stay in the company for X number of years. So it is a failure to vesting condition, and we need to account for that as an expense reversal in the P&L account. I hope it is clear to that question.
Yes, sir. Thank you for such elaborate reply. Now I hand it over to the team to take it forward. Thank you.
Yeah.
Okay, just one question in addition to the questions that were asked by Utkarsh. In one of your replies, you said that in the ESOP trust, company can give loan to the trust to buy the shares, for buying the shares by the employees. Would this not be in contravention to Section 67 of the Companies Act, giving loan to a third party for purchasing its own shares?
So what I said, that purchase will be done from the open market first. For example, company have given the loan to the trust, and then trust will purchase from the open market as a secondary acquisition the shares. That shares will be utilized for the purpose of exercise. Like whenever you exercise the option, we have to give that equity share to the employee. So that time we will give this equity share to the employee. Now he is becoming the shareholder. After that, as a marketplace, company may have that option that trust will be used as a marketplace again, that whenever they want to purchase the share, they can offer or they can ask the employees to sell their shares.
You can sell with you, but I think that
but on section 67, as of now, I don't have any handy reply. So but this is the regular practice in the ESOP trust, that they are used to purchase for the secondary acquisition. That's the key purpose of the ESOP trust.
Okay. I now ask CA Pritesh to propose a very well deserved vote of thanks to our today's speaker, CA Karthikeya.
Thank you, Gautam Bhai. I thank the Women and Young Members Excellence Committee of ICI, its chairperson CA Preeti Sawla and vice chairman CA Avek Chatterjee for initiating such a series of seminars. Today is the 6th session under the Youth Excellence Symposium on the topic of practical aspects of ESOP implementation and ESOP valuation. We all know that any topic on ESOP is very complex and not so simple, but our today's learned speaker, CA Karthikeya Kandoiji, through his vast experience, has explained us in very simple and lucid language. Karthikeya sir has explained us right from the definition and basic concepts in ESOPs to the complex aspects of taxation, accounting, Ind AS, fair valuation, etc. Thank you, Karthikeya sir, for explaining the topic in such a minutely way. I thank all the participants for encouraging us to conduct such sessions and request them to give their valuable feedback and suggestion on any topic you wish us to conduct. Lastly, I thank the technical team for their seamless support in running the online session. Thank you very much. Thank you, Karthikeya.
Thank you very much. Thank you.
Thank you. Technical team, we can end.